Hey everybody, Ben Barnhart here with On Point CRNA with another quick video. Just got done with an initial meeting with a prospective client, and I'm starting to see a lot of consistency where they've got a CPA or an accountant, they've got a financial advisor, the two aren't talking to each other, and there's a lot of missed tax opportunities. So if you are a CRNA that is doing 1099 work and you have an S Corp, this video is for you. So I'm going to go through this pretty quick, keep it high level, full disclaimer, none of this is tax advice. You should consult with your tax professional. With that said, let's get into it. So I'm going to give you the case, and then we can kind of go through some of the ideas that we had. So we've got a CRNA paying herself 186 grand W-2 through her S Corp, and then she has a $100,000 S Corp distribution. The whole idea with the S Corp, for those of you who don't know, is to reduce the amount of your income that you're paying into the Social Security system and Medicare system. So payroll taxes, FICA taxes. That rate is 15.3% on the first 176 grand and some change that you make in 2025. So if you're already over that limit and you're paying yourself 186 grand, why would you do that? Right? It doesn't even make sense to even have the S Corp at that point. Well, her accountant told her that that is the way to maximize her solo 401k. You can do up to $70,000 pre-tax into a solo 401k as a combination of your employee and employer contributions if you're under age 50. So that's the number to get to that 70K. With that said, she also had about $1,000 a month or 12 grand a year in healthcare costs. And then she has a max contribution. You can do 85.5 in her HSA this year. So that's kind of the baseline. So first off, 186, like I said, that probably doesn't make sense to pay yourself that reasonable wage if you're over the Social Security wage base already. There's a lot of additional filing costs and hoops you got to jump through with the S Corp, especially if you're in multiple states. Kind of a moot point if you're already hitting that, Social Security wage base. So what we decided to do is reduce the fair and reasonable wage that we're going to pay her. So essentially, every $1,000 that you reduce that W-2 wage, and it has to be fair and reasonable, not tax advice again. Everybody's situation's different, but let's say we're going to use 120. Every $1,000 less, it saves you about $153 in taxes. So by reducing that Social Security or that W-2 wage from 186 to 120, that's going to result in tax savings of about 10 grand in tax savings here, right off the bat. Now the rub is we're not going to be able to contribute as much on a pre-tax basis to her solo 401k. So what we're going to do instead is modify her solo 401k. It was an off-the-rack plan that she had with Fidelity. It didn't allow for a few different things. So what we're going to do now is contribute the maximum still, 23.5 as the employee. And then we're going to contribute 25% profit sharing. That amounts of the 120 grand, that's another 30K. So now we're at, and this is the employer portion. So now we're at 53.5. Well, the max, like I said before, is 70. So if we net that out, we still got 16.5 here to work with. So with this other type of solo 401k plan, we are going to set up two different types of sub accounts. We're going to have a pre-tax that we already have, an after-tax, and then a Roth 401k. So what we're going to do now with this is contribute to the after-tax portion, and then immediately do an in-plan conversion to the Roth. So this is what's known as the mega backdoor Roth strategy. I have a lot of videos and case studies and blog posts on the website. I'll be sure to include in the link to this video if you want to get into the nuts and bolts of how this works. But essentially now she's putting away 53.5 pre-tax, which is less than before, but more than pays for itself with the savings on the reasonable wage front. And now we've gotten another 16.5 into her into an account that we don't have to pay taxes on any of the gains, the Roth 401k. On top of that, she had about $1.4 million in an old rollover IRA. So she makes too much money to outright contribute to a Roth IRA. Uncle Sam knows that these accounts are a good gig. If you make too much money, you can't outright contribute to it. And even if you don't make too much money, they limit how much you can put in there. So this year, you can do $7,000 into a Roth. Well, she's exempt for that, or excluded from that, just because she makes too much money. So what we could do is a regular backdoor Roth contribution, whereby we would contribute to a traditional IRA and then immediately convert it to the Roth IRA. Now the catch is here, you can't do it if you have pre-tax money outside of an employer-sponsored retirement plan. In this scenario, that's this account. It's in a rollover IRA. So what we're actually going to do with this new solo 401k is do a reverse rollover of this $1.4 million into her pre-tax sub-account on her 401k. Why would we want to do that? Because now she doesn't have any pre-tax money outside of a quote-unquote employer-sponsored retirement plan. It's all in the solo 401k, and thereby preserves her eligibility to execute the regular backdoor Roth strategy. So now that we've done that, we can take the $7,000, contribute to a traditional IRA, and then convert it to a Roth IRA. So this is, the conversion step, and then this winds up in the Roth. So we sidestep the income limitation. It's what's known as the backdoor Roth. So another big win there by being able to funnel more money into an account that's tax sheltered in the future. Now we don't get a break tax-wise today, but we also don't have to pay the taxes down the road. So any of the gains in there inside of there are tax-free. All right, so the next thing that we did, payroll optimization. So we already talked about reducing that payroll tax. Now I see this one all the time, where what we want to do with this 120 is actually run through the $12,000 in healthcare costs and that 85.5 of HSA contributions into the solo 401k, or into the W-2 reasonable wage. She is the only she's more than a 2% shareholder. She's the only shareholder. So thereby, it has to be a taxable benefit and paid by the employer when you run it through your payroll. So we're actually going to force this to be taxed. And then we're going to take it as a deduction. So we still get to write it off, but on her personal 1040 tax return. Again, why would we want to do this? Well, because these benefits sidestep that 15.3% payroll tax. So now we've got about $20,000 there. That's going to save us roughly another, let's call it $3,000 in taxes. So those add to that fair and reasonable wage that we're going to pay, which means we can actually pay her less of a salary to still get to the 120. Everything, contributions and everything are still based on the 120. These are just included in that. We avoid another $3,000 in FICA taxes. The other thing with the solo 401k, if we set up the right type of solo 401k, not only do we get those 3 sub-account types, but there's a tax credit available out there called the auto-enrollment tax credit. Uncle Sam knows that a lot of people are not saving for retirement, so they want to subsidize employers to stand up these type of plans and incentivize their employees to automatically contribute to it when they hire a new employee. Well, if we're setting it up, obviously you're going to contribute to your own plan. So you get a $500 tax credit for checking the box on this auto-enrollment tax provision within the plan for the first 3 years. There's $1,500 in tax credits, not deductions, like literally $1,500 back more in taxes. So between the optimization of the payroll, reducing how much that fair and reasonable wage is, funneling the HSA healthcare costs through it, the auto-enrollment tax credit with the solo 401k, the mega backdoor strategy, doing the reverse rollover to get the regular backdoor strategy, all of these things start to add up and can really move the needle in a meaningful way. Now, the icing on the top with this whole thing is, given her age, and her goal to retire and hammer as much money away as she can. We also are going to put together another type of plan, and this is a little bit more of an exotic plan. It's what's known as a cash balance pension plan. So there's a lot of different ways to structure this, but to keep things really straightforward, we're going to do another $50,000 into this cash balance pension plan. In given where she is tax-wise, that's probably another 15 grand or so in tax savings from this type of plan. So all in all, 1,500, 15,000, 3,000. The mega backdoor strategy, which you don't get a break for today, but this saves you a lot of money in taxes in the long run. Now, this is a properly structured scenario, and there's a lot of moving parts here. There's a lot of tax reporting that goes into getting this all dialed in. It's not just about preparing the tax return. I found that most accountants are great at, accounting for things that have already happened, and putting numbers into boxes. What I do see all the time is just missed opportunities like this. A lot of this has to be stood up before the end of the year. So if this is something that appeals to you, which I think it would everybody, nobody wants to pay Uncle Sam more than they have to, please reach out. Like I said, I'll put some links to our calendar and different blog posts that get way more into the weeds on some of these strategies. And I'm happy to help where I can. So with that said, hopefully this was informative and hope to talk to you all soon. Take care.